Hi, everyone, and welcome to today's webinar. My name is Anna, and I'm with the New Mexico Small Business Development Center. Today, we have Amanda Davis joining us, who is a certified SCORE mentor, holds a bachelor's degree of business administration and accounting, and is the founder and owner of a business consulting and bookkeeping firm here in New Mexico. Amanda has guided many small businesses, creative professionals, and nonprofit organizations towards financial clarity, and will be presenting today's topic, basic bookkeeping. Amanda, if you wouldn't mind proceeding to the next slide, that would be great. Thank you so much.
There we go.
We will be using the Q&A function to take questions and welcome attendee participation, so don't hesitate to ask us any questions you may have. I think we might have a fairly small audience today, so if we can make it as interactive as you guys would like to, definitely don't be shy. We love questions around here. And we'll answer questions just as they come up, most likely. So yeah, just put them into the Q&A function. And then I believe there's another slide coming up here, the next one, regarding COVID-19 business resource links. I won't go over these in detail, but I'll send you a copy of the presentation at the end of the webinar so that you'll have this information. And then lastly, please visit our website at nmsbdc.org to view our upcoming no-cost webinars or to sign up for our no-cost counseling services. I'll also send a follow-up email to you with this information. Thanks so much for joining us. And without further ado, I'll hand it over to you, Amanda.
All right, well, thank you very much, Anna. Okay, so we have a lot to cover in just a little bit of time. And we did kind of look and see that we had a smaller audience registered. So I thought instead of just barging through the material that I would take some pause and have more of a conversation. So feel free, you do not have to raise your hand to take yourself off of mute and ask questions or put them in the chat. Hopefully Anna can help me field those as I'm going through because I can only see so many things at one time. But what we're going to do is we're going to go through the outline of what we're doing here. Accounting principles and bookkeeping. Why would you bookkeep? What are the principles and practices? Financial statements and ratios, top mistakes to avoid, terminology, reports, and so on. The training objectives is what you're going to take away at the end of this. So hopefully you understand the process and the purpose of bookkeeping, why it's important, how to bookkeep and the accounting terminology, understand the basic financial statements and the basic accounting ratios. And I just thought I'd put some fun history in here for those nerds in the room. I am leading the nerd discussion here. Bookkeeping was established back in the late 15th century when a mathematician and a monk described the double entry bookkeeping in their book. And so basically, bookkeeping hasn't changed all that much. So they established it back in the 15th century, and we're still kind of doing the same thing, basically. Now, because the basics haven't changed a whole heck of a lot, but technology has changed how we do it. So the idea is that transactions are recorded in two separate places. That's where the double entry bookkeeping comes in. One is in the journal and one is in the ledger. And so whenever you record it in one, it has to balance back to the other. And that is known as the trial balance. And then from there on, you go ahead and start working on preparing the financial statements. Okay, favorite picture in here. Oops. Let's come back here. I see stuff in the chat. Okay, so top 10 mistakes and how to avoid them. So we have some various mistakes, and in here, I think I got myself a little bit out of order here. The SBA says that half of new businesses fail within 5 years due to poor financial management. Now, bookkeeping can help you have good financial management. So if there is something indicating that you're having a problem, that something's not trending in the right direction, you're spending too much money on a specific thing, or not enough money's coming in for a specific campaign, it's going to show in your books. So if you're not doing your books, you don't have the check engine light on, basically. So you don't know that you're going to get stranded in the middle of the road in night somewhere. So that's one thing. Wrong accounting method. Intermingling personal and business. So if you have one account and you record everything in that one account, that can cause you great harm. There's liability issues in it, but it's also kind of a nightmare to manage and figure it out. Misclassifying workers. So if you have somebody who comes to work with you and you're like, well, are you an employee or are you a contractor? And some businesses, many businesses would like to say, okay, you're a contractor because it saves them money. They don't have to do the payroll. They don't have to do things around HR. They don't have to deal with payroll taxes. They don't have to report anything. Well, once at the end of the year, it's a lot simpler. But if you don't understand and you have an employee and you put them as a contractor, that could be a very big costly problem for you. Not reconciling stuff. I've had clients and I talk to them about reconciling their bank accounts and they just look at me like, what? Why would I do that? I go and log in, it's on my phone, I see it, I don't need to reconcile. And reconciliation is one of the first layers of internal controls to be sure that everything's kind of working through. So reconcile your accounts, please. And if you're not sure why, please let me talk to you afterwards. Lack of controls, access to accounts. My father's company had somebody and they had a list of checks, that paper checks that you print out. And in the checks, they actually went in and took checks from the middle. So by the time they realized that there was numbers missing, people had written checks and cashed them, which is reconciling also helps you catch that. So there's that. Misunderstanding what profit means versus what cash means. A lot of new businesses will look at their cash in the bank and they're going to say, wow, that's how much money I made. And that's not true. That money might be earmarked for things like taxes and maybe you lost, money on your profit and loss, but you actually have cash in the bank. That's a scenario that's highly likely. DIY bookkeeping. If you're doing your bookkeeping and you're not paying attention, you're not doing things really well, that's really interesting. You can get yourself in trouble. Things like some of the stuff we talked about. No record keeping. Doing it yourself is way better than not doing it at all. So that's bad. Insufficient checks and balances, meaning you don't have ways to control people from stealing from you or finding out there's a problem. I had a client who somebody hacked their website and they put a lot of payments through, and those payments resulted in real merchant fees, and it was kind of a mess to get back. So there were fake dollars paid to them, but they were paying out real merchant charges to process those fake credit card charges. So that was interesting. Okay, I'm gonna come back over here and see if I can't push this forward. Okay, terminology. Getting to know it. So in here, basically you're going to learn a bunch of things and I'm going to kind of go through. Is there any questions or thoughts? Anybody can happily chime in at this point if you like.
So I don't see anything. That the chat was all me chatting to people, just so you know, Amanda. But yeah, again, don't be shy. We have a small audience today, and we'd love your participation. So, and I will let you know if anything pops up, Amanda. Thanks so much.
Thank you. Okay, well, we're just gonna move right in and raise your hand. Put something in the chat. I see Samantha may have raised her hand. Hey, Sam.
Oh, yep, she just did. Let me go ahead and allow her to talk. All right, you should be good to talk. Thanks, Sam.
Hey, yeah, so Amanda, just a question to kind of keep in mind as you're going through here. So as a business, how do you figure out when's the right time to pick up an accounting application like QuickBooks, for example, versus just using Excel, where you're just sort of tracking like revenue and expenses and maybe some cash flows. So I'm just wondering if you'll get to that as part of this presentation, because I get asked that question all the time.
That's not specifically listed, so I appreciate you bringing that up. Thank goodness we have a small group here today. So basically, that's kind of a decision that has to be made kind of on the management scale level. So if you're just starting out, you don't have a whole lot of transactions and you don't have a whole lot of things to track. Maybe accounting software might be just a bit more of a cost than it is a benefit at that time. So once you're several months in and you're actually having a good number of transactions, that's probably a good time to invest in something. The upside with Excel is it's low cost. And if you're good at it, it's not a big deal. And I've made financial statements in Excel, and it's really something that's viable. But the downside is you're doing everything by hand. And so I've got clients that come to me and they're like, Amanda, will you just train us how to do this? And before I let them pay me to train them how to do it, my first question is, but will you do it? And so I think that's kind of the bigger question. And it kind of doesn't matter which program. The Excel is going to take a lot more work, though, if that helps answer your question.
That's
All right.
great. Thank you.
Thank you so much. Okay, we're going to keep moving on. The accounting equation, you're going to see we're doing a lot of terminology that we're repeating, so that if you are here for the first time or you're kind of a novice at this, then hopefully you're going to understand and pick things up. A lot of this, I'm not expecting you to come out and memorize and know these terms by heart, but I'm hoping that you see them here. You're going to get, we're going to supply you this PowerPoint at the end of the presentation for attending this class. You will be able to go in and look up these terms. I specifically did not put the definitions in there, but on purpose, so you can go kind of look them up for yourself. And hopefully by the time you've seen it for the second or third time, you're going to be a lot more familiar with it. So the accounting equation, you may or may not have heard this, but assets equals liabilities plus shareholders' equity. And so in terms of bookkeeping, there is a form called a balance sheet. And the only way the balance sheet balances is when assets, the total number of assets you have equals however much you owe people and what remains in the company. So those things have to total each other. Accrual or cash basis, we talked about being on the wrong basis, right? Accrual basis is recognizing income and expenses when they're incurred. So the best example I can give you of this is a credit card. If you bought a plane ticket on a credit card, you're not paying that plane ticket off until the bill comes due several weeks later. And then the bill due date is probably several weeks after that. So you didn't actually take money out of your bank account for that transaction until you've actually paid off the credit card. So on a cash basis, you record it when the cash is paid. On an accrual basis, you record it when you ordered that fare and you said the money's owed. So if it's a credit card, accrual basis is when it comes in and you've paid it, and cash basis is when the money goes out and you've actually paid the bill. That's a really simplistic way of looking at it. But it's something that you guys probably have all heard and can kind of put in your head. An asset is what you can make money on. So if you close your business, an asset is something you can get out of the business. It is your bank account. It is your inventory. It is money that people owe you because you sold them services or goods. So assets are things that you can get money out of. Accounting period is the length of time it takes to complete the accounting cycle. It's typically a 12-month period. Sometimes you're looking at things in shorter time frames. An accounting period can be a calendar year. Sometimes people use a fiscal year. I'm not sure if you're familiar with that, where they say, okay, we're going to start the year in July 1st. A lot of governments do that. And then they end on June 30th. So understanding what period you're looking at is important. Accounts receivable is monies that are owed to you. So you invoice somebody and then the money comes back to you, hopefully later, hopefully sooner than later. Accounts payable is the exact opposite, is monies that you owe, like your credit card company, that you have to pay later on. And accrual, we talked about the accrual basis, and accrual is an income or expense that you owe, but has not either been paid or received yet. So that's you recording that transaction that's been incurred, either money coming in or money going out, but that money hasn't moved yet. Balance sheet, we talked about that. That's a financial statement. It's a comparison between all of your assets, equity, and liabilities. Cash flow, that shows the money going in and out of your business. The chart of accounts, the listing of categories. Your business transactions. Think of your chart of accounts as of a filing system for your business. So if you went to Starbucks and you took out a client to Starbucks, then that would be a meal, or meals and entertainment would be the category. If you went to Office Max and bought printer paper, that would be office supplies. So those are your chart of accounts. Cost of goods sold. This may or may not apply to you, but these are things that your business spends to produce money. So if you sell t-shirts, when you purchase the t-shirts to be sold, that is your cost of the good that you sell. Double entry bookkeeping, we talked about that. Everything is recorded in two places. If you record it once, there is a debit and there is an equal and offset credit. And we're talking about debits and credits now. So each bookkeeping transaction has two sides, double entry accounting. One side of a transaction is a debit, the other side is a credit. Assets and expenses are increased by debits and reduced by credits. Income, equity, and liabilities are increased by credits and reduced by debits. This is a little bit more of a complicated thing. You don't have to know this to do your own bookkeeping. The software will do it for you. And that's another thing, Sam, if you're doing double entry bookkeeping in Excel, you're going to have a heck of a time. But if you're doing it with QuickBooks or Xero or some other platform, it does it behind the scenes for you. So it kind of helps out a little bit. Depreciation is whenever you have a big asset like an automobile and you take the asset's value over time. So let's say you bought an $80,000 vehicle. You don't just take $80,000 as a deduction in 1 month because the vehicle is useful for longer than a month. So you take it over several years. So that's depreciation. Equity or capital is what is owed to the business or shareholder. So it's basically what's left over. It's what remains in the business at the end of the period. Expenses are money your business spends on operations and overhead. Fixed assets, very similar to a car. It has everything to do with depreciation. They could be buildings, land, equipment, vehicles. Fixed expenses are things like rent. These are things you're going to pay the same amount of money to regardless of however much you use it. So if you have, rent's the perfect one, right? It doesn't matter. Gym membership, that might be a great one too. It doesn't matter whether you stepped a day in the gym, you're paying that $10 monthly fee. So that's a fixed expense. It doesn't matter how good your business is. It doesn't matter how much you use the item. It is going to be the same all the time. A general ledger. So we talked about the journal and the ledger. The general ledger is one piece of that double entry bookkeeping, and it is made up of your assets, your liabilities, equity, income, and expenses, and it shows you all the detail. The journal is the daily transactions recorded that end up in the ledger. Liabilities is what your business owes, like a credit card. If you took out an idle loan for the pandemic, if you took out an economic injury loan, you have to pay that back. That's a liability. Income and revenue is your sales, what you sold, and money is coming in. Payroll, the list of employees and how much you pay each one. A profit, we talked about this, profit versus cash. Profit is what your business has earned after cost of goods sold and expenses are subtracted from income. Profit is not the same as cash on hand. Reconciliation, we talked about that. The process of verifying the balance in certain accounts, checking credit cards, loans, etc., against statements from outside sources, usually a bank. A subledger, well, that's kind of the journal, containing the detailed subset of transactions. It's very similar. A trial balance is a statement that tells you if your debits and credits are accurate before you create financial statements. That's the balancing of the debits and the journal and the ledger. Variable expenses, we talked about rent as a fixed expense. A variable expense is like a utility. A utility is like your gas bill or your electric bill. And so you're not going to pay the same amount each time just because you have an agreement. You're going to pay for the amount of energy you used, plus all of the surcharges and taxes that they try to apply to that. So variable expenses is very much like a utility. A fixed expense is very much like a rent payment. All right. Then we're going to move on to financial reports. Any other thoughts, questions? Just jump on in here if you like. And we're just going to keep running on here. So the balance sheet, we're going to talk about all the different reports here. We're going to go from left to right, top to bottom. And so the balance sheet includes your list of assets, your list of liabilities, and the shareholders' equity, which can also be called retained earnings, which also can be called capital. And there's a number of different names. So don't get it confused. This is basically what remains in the company, your ownership. Let's see, aging reports, accounts receivable. So if you sold somebody something and you gave them an invoice to pay you later, that is an accounts receivable. That means money will come back into your pocket at a later date, in all hope. And then accounts payable is the opposite, where somebody sold you something and gave you a certain amount of time to pay it back, very much like a credit card. Profit and loss is your revenue, which could also be called income, which could also be called sales. Less your cost of goods sold. We talked about the t-shirt, where if you sell t-shirts and you buy the t-shirts to sell, the cost of the t-shirt that you sold is included in cost of goods sold. And expenses, which would be made up of the fixed expenses and the variable expenses, things like rent, like meals, like utilities, so on and so forth. And then cash flow. Cash flow is a little bit complicated, but it's also very important. The one I'm going to teach you is more of an academic cash flow statement, which tells you what happened with the cash. So cash came in during and out during the month, and you want to know how that cash was used. Was it used for operating? Was it used for investing? Or was it used for financing? So it really shows you how the money flowed through. A lot of people, when they say cash flow in layman's terms in bookkeeping and business ownership, they look at projections, meaning how much cash do I need to have on hand? We're not really going to go through cash flow projections here. That's a little bit different, and it's very important. So that could be something that you could look into a little bit more as well. All right, the balance sheet. And again, there's a lot of things that we're going to say in repetition. And the reason we're doing it in repetition is because I'm hoping that if this is the first time you're seeing it, or if you're more of a novice at it, that the more times you hear it and see it and experience it, the better you have it at retaining it and having it be useful to you in the future. So this is kind of a visual representation of the balance sheet. And I really like the way this kind of worked out. When we talked about the accounting equation, remember assets equals total liabilities plus shareholders' equity. This gives you the boxes to fill. All of the assets equals whatever is owed. So assets is things that make you money, liabilities is things that you pay money for, and then equity is what's left over. So this gives you kind of a visual representation of that equation. Now, assets are things that you could take money out of your business, right? So they are your bank account. If there's money in your bank account, that's an asset. Accounts receivable, meaning you sold something to someone and you gave them time to pay you back. So you have a list of people who owe you certain monies, and that amount of money is collectible and therefore is an asset for future time. Fixed assets, like you bought a building, you bought a car, you bought a $3,000 computer because you make movies and you need video equipment and that kind of stuff. It could be any kind of large purchase that is used over time and could eventually be sold. So if you close business, you could sell the vehicle, you could sell the building, so on and so forth. Current assets. So when you hear, in terms of accounting purposes and bookkeeping, when you hear the term current means 12 months or less typically. So you have something due within a year. So you would normally think of short term, like a credit card payment, or a short-term loan that's due within 6 months or so. A long-term, these are assets. So these are things that will come due within 12 months, and the long-term means it's longer than that. So these are things that you've invested in, and the payoff's going to be either coming due very shortly or coming due after 12 months. And then you see the same thing on the flip side where there's money owed, the liability. So a liability is accounts payable. These are people that sold you something and gave you some time to pay for it, so you have to pay for those charges. Credit cards, if you take out a line of credit, if you take out a loan could be a current loan, or they could be long-term, something current, very much similar to a credit card, or kind of a short-term loan. Long-term liabilities might be something like the idle loan. We talked about that during COVID. A lot of people got those economic injury loans that they brought out through the SBA, and those loans are paid over 30 years. They're much more like a mortgage, so that's clearly a long term. And then shareholders equity, there's all these terms that say shareholders equity, right? But right here, the terms that we're using in here are very much for a corporation, but they could be members equity, they could be owner draw, owner contribution, they could be capital, they can be equity, they can be retained earnings. So in here, if you have stock, you would have common stock. You may have additional paid in capital and retained earnings. I'm not going to get into all those definitions because it's not as fun as you would think it is. I know we're all nerds here today, but basically all you really need to know is shareholders equity, retained earnings, capital, all of that means the same thing, which is what remains in the business after your assets and liabilities. So now we're going to go through the visuals. I went on Google Images and found some fun little fake balance sheets and financial reports. And in the balance sheet, I thought it'd be good because of the accounting equation to break it up into the three parts. So right now we're going to look at the assets. And again, we're reiterating a lot of this, right? So we have cash, we have accounts receivable, inventory. Talk about those t-shirts that you're going to sell that you bought. Let's say you bought 1,000 t-shirts, but you only sold 100 this month. Well, you have 900 t-shirts in this inventory area, and the value of what you paid for those t-shirts would remain in here. When you sell the t-shirts, they would get removed to your cost of goods sold. So they kind of, the balance sheet and the profit and loss kind of work together here. Then you have current assets. These are things that are probably going to be due currently. I would imagine you wouldn't give somebody longer than a year to pay you if you sold them something. If you do, you and I need to talk outside of this because that's not a good business practice unless you're in the business of lending money. Fixed assets, plant, equipment, and because anything that's a fixed asset will be taken over a period of time. We talked about depreciation. That is allocating that expense over a period of time. So in the balance sheet, it would accumulate as the depreciation is taken. So every year it would increase until the net amount, assets minus depreciation, goes down to zero. Very exciting. Okay, liabilities. These are things that if you close a business, you have to pay it off. So accounts payable. This is like we keep talking about. You bought something from somebody and they give you 30 days. Let's say you bought those t-shirts and because you bought a volume, they're giving you 15 days to pay the bill. That would be an accounts payable because you haven't paid it yet, but you have to pay it. Accrued expenses could be if you're on accrual basis and you incurred an expense, but you haven't quite paid it yet. Under revenue, this is kind of a new term, meaning somebody told you and has agreed to or signed a contract that they're going to pay you for something, but you haven't fulfilled that contract, so it's not quite earned. And then long-term debt, we talked about that, where it takes longer than a year to pay that off, very much like a mortgage. And then we're going to talk into the shareholders' equity. So again, to give you just a visual of what that looks like, paid in capital. And these are all terms, like I said, for a corporation. So these are things that have stock. So they have so many shares authorized, issued, and outstanding, and there's all these terms, and they may or may not apply to you. You may not have additional paid in stock, and that's okay. You may or may not have treasury stock, and these are all just very specific terms to corporations. All this really means is what remains in the company at the end of the day. So, and typically what is not really shown in here would be the allocation of that year's net income at the end of the day that would be allocated through here. So we come back to the accounting equation. Assets equals liabilities plus shareholders' equity. I know I'm saying that a lot. It sounds pretty intense, but at the end of the day right here, the reason is this is a good foundational thing for you to understand what that means. So assets is what you own, liabilities is what you owe, equity is what remains. That's what you get. Now we're going to move on to the aging reports. I didn't put copies of the aging reports because they are a little less exciting than the other ones. And basically, they're just kind of a list of who owes you and how long the money is owed. And accounts receivable and accounts payable are the exact same thing, but one, somebody owes you money, and the other one, you owe somebody money. And so what it is the aging report is just that. How long, how old are these things that people owe you? You said they were due in 30 days. Did they pay them in 30 days? Did they pay them in 60 days? Did they pay them in 90 days? So on and so forth. And the reverse, did you owe it in 30 days? Have you paid it in 60 days or 90 days? So on and so forth. And so I put this little caption in here because I thought it was funny because I'm a bookkeeping nerd. If an invoice is due in 30 days, we pay it in 60. If it's due in 60 days, we pay it in 90. And if it is due in 90 days, then they probably don't need the money anyway. So I thought that was kind of hilarious. Okay. The profit and loss. This is where you're probably going to spend a little bit more time and your energy in. It's going to tell you a lot of things. So the balance sheet's kind of something that rolls forward. So it's a car. It's something that you're going to keep over time. And income statement or profit and loss, you can call it either one. And that's stuff that happens at that time. It's like, how much money did you spend this month? It's kind of a snapshot. And so, and the balance sheet's kind of like, well, what's the balance at the end of the period? Because it's been incurred since you opened the account. And it is comprised of the revenue, which includes your sales of products or services, commission, or any other ways that you make money in your business or your organization. Cost of goods sold, we talked about that. T-shirts again, materials, and freight in, and anything else directly associated with it. So when it comes to cost of goods sold, if you buy those T-shirts and you had to pay shipping, then the shipping you paid to get the T-shirts to you is part of your cost of goods sold. But the shipping you pay to get them to your customers is not. That's kind of an interesting thing. Another direct cost is, let's say you bedazzle those T-shirts. I'm not sure that that's something that would actually happen nowadays, but you don't know. I'm not judging. And so if you do bedazzle that shirt, then all the little rhinestones, the glue, and the time and labor it costs to do all of that, to alter that material, that would be like cost of labor and other materials and so on. So that would be what other direct costs might be if you need a fun little example. Operating expenses, we talked about fixed versus variable, and we have different things. Rent clearly is a fixed asset. Fixed expense. Advertising, well, you pay for as much as you use. So that would be variable. Payroll use typically variable. It can be both if you have a salary employee. Office expense, things like meals and entertainment, utilities, all this stuff. And then there's things that just don't quite fit anywhere else. And we put them in this other category. And what's in this other category is things that happen because you're in business and because you have a bank account or because you did something. You're in operations, but they're kind of a byproduct of something else. And it's not really what you're in business to do. So unless you're in the business of lending money or investing money, interest and dividend income is something that happens because you had a bank account or because you had an investment account or something. It's not your purpose of being a business or why you started a business. So it's kind of, it's not operational. So it lives in this other area. Penalties and settlements. So if you filed something late and you paid a penalty because of that, then that would go in there. And other things could also end up in here. Anything that really doesn't have anything to do with a primary reason that you're in business and the way you operate. And then again, we have the example of how it looks on the profit and loss. So you have the revenues less expenses equals profits and loss. And so that kind of goes into that. And then we have an example of Sample Products Company. They're pretty behind on their bookkeeping. We should talk to them about that. But they made $100,000 of sales. They had $75 of products that cost them to make those sales. And then you get down and they put another 13 grand in operating the business, and they had another 6 grand, it looks like, in excuse me, in the other operating costs, like we talked about, other income, other expenses. All right, before we move on to the infamous cash flow overview and statement, is there any thoughts, questions, concerns in here?
I'm not seeing anything on my end, just to let you know.
No worries, no worries. Okay, this is very exciting. So we're not doing a cash flow projection here. We're actually doing the physical statement that you would see academically, and that is produced in many financial statements. And the purpose of a statement, cash flow statement, is really to identify how the movement of the cash occurred. It's not to project how much money you need or what's happening in terms of balances. It's really to say how much money was really spent in these areas. So that's what we're focusing on. Operations is business, cash from business activity. So you sold something, money came in. That is cash from operating. Now we just kind of drilled into that interest is not an operating expense, but we don't have a different category in here. So accountants aren't super flexible. So they just decided that that lives in that category, which instead of making another one. Cost of goods sold and operating expenses, rent, utilities, payroll, that kind of good stuff. So this is like money that went in and money that went out in order to run your business. Investing activities. That is, you had a car and then you're like, hey, cars are going for crazy dollars right now. I should sell this car I'm not using, make some money, and that'll be the end of that. And so money came in the door. Well, that is a investment, like money came in due to an investing activity. So you had invested in that car and then you sold it and some money came in. Or let's say you bought a car during the height of the pandemic, like I did, and buying that car was a great opportunity. And so because the cash went out whenever you purchased the down payment or whatever on that car, that is in around investing in the business. Also accounts receivable and payable. So because when people buy something from you in terms of operating, in terms of this statement particularly, it doesn't mean it's a sale if you give them time to pay you later. So you're investing in the opportunity to make that sale. You didn't make that sale that day. So that sale kind of lands into this investing category. This statement is really kind of complicated. We could probably spend an entire semester on this statement, and a lot of people have trouble with this one. So if you're like, whoa, what's going on here? It's okay. Deep breaths. Financing are things from putting your money into instruments that will make you money, like dividends, stock repurchases, payments of long-term debt, and loans. So let's say you loan somebody a big dollar amount and that money came due. That was you financing something. So in this particular example, I know the terms kind of get interchanged here and there for different things, but that's what it means in terms of this particular statement. And now we have a copy of the statement. And so it really kind of sums up, okay, well, here's the net income, and then you add or decrease based upon what item that happened. So if there's depreciation, you would go and say, okay, well, the net income, and so you say, okay, money came in and went out due to all of these things. And then this is the total net change in terms of operating, investing, and financing. And then you have the change in cash and the beginning cash, and then everything kind of reconciles out. So again, this is not to project cash flows. It's really to identify how the money was spent throughout that period. Fun times and our ratios. If you're going to have investors, if you're going to have creditors or lenders, these things are going to be important to them. So after you get done with your financial reports and everything looks good, people will probably start probing you about certain things like this fixed cost and these types of things. And so if you don't understand what these ratios are when people are asking you for them, this gives you kind of a starting point. And there is vastly more ratios out there that you can go nerd out on obviously, but I tried to put in ones that you might hear more frequently and might be more relevant. So the break-even point is basically how much do you have to sell to not make any money? And that tells you or your investors or whomever it is, how much you have to sell to make a certain profit and so on and so forth. So doing the benchmark. So the break-even analysis is something that you're going to hear a lot of. Return on equity. Oh, we're going down to the current ratio. We're going top to bottom, excuse me. Current ratio measures the liquidity of the business, its ability to meet its current obligations. So basically what this means is if you have short-term loans, credit cards, and all this stuff outstanding, they want to know if you sold off or received these assets that are in this like 12 period cycle, right? And they're going to say, you know, hey, you have receivables that are due in the next 30 days and you have payables due in the next 30 days. How good are you financially positioned to pay off those liabilities from these two things? And so it just really tells somebody who's lending you money or investing in your business how financially sound you are, because if you have more assets than is owed, especially in a certain period, that positions you differently. Debt to equity ratios. So this basically this is the entire second half of that accounting equation. Total liabilities divided by shareholders' equity. So it's to evaluate the company's financial leverage, ability of the shareholder to cover all of its outstanding debts in the event of a business turndown, i.e. COVID. So if a global pandemic hits, do you have enough equity in the business, enough ownership, enough that remains, enough amount that you get that could pay off all of these things that you owe? Let's say things went really, really bad. Return on equity measures the financial performance. So it gives you the net income divided by the average shareholder equity. So basically what it means is that if you say on Shark Tank, I want this much money for this much ownership of my business, then you can take that net income and divide it by however much the equity is and break that out by however ownership. And if that's a small number, a small margin, then they may not want to put that money into your business. So these are things that really kind of work out in the real world. So it's your ability to perform based upon that investment. The gross margin, because that's included in the business break-even point, I wanted to make sure that because we're using this term, we're actually giving you the equation for it, so you don't have to just go look it up. And so what that means is the direct sales, you sold these t-shirts, but you also paid a certain amount of money for those t-shirts. And so for every shirt you sold, you have a cost per shirt. And so you take whatever the sell was, less however much it cost you for however many shirts you sold. At the end of the day, that's how much is your gross margin. That's how much money is left over, basically. I hope that's pretty clear. And then the quick ratio, it is also called an acid test. It's very exciting. It's an indicator of a company's short-term liquidity position and measures a company's ability to meet its short-term obligations with its most liquid assets. So it's cash, and I have it kind of a little bit different. Cash minus inventory divided by current liabilities. It's also cash plus market securities and accounts receivable. So it's a cash, marketable securities, and accounts receivable are current liabilities. So that's kind of what it is here, less the inventory. So it really kind of gives you an idea of how quickly you can meet these short-term obligations or how well you can meet these short-term obligations. Okay, working capital is a company's ability to pay its current liabilities with its current assets. So we kind of talked about it in terms of a ratio. This gives you an idea of the money that remains at the end of the day. It's a simple this amount less that. And so that just kind of gives you a current idea of what that looks like. And I can go into more detail, but we have a small group, and I see that we have a number of people asking a few questions. I think, Anna, you have responded to several of those people. Yes, you are going to get the presentation. It sounds like the recording will also be available if you like, and I think it's going to be on YouTube. But do we have questions, thoughts, concerns? I'm opening it up with my lovely cat photo.
And yeah, in the meantime, I just wanted to let you know, Amanda already said it, but we'll have this recording available on YouTube. We'll have it on demand, and we'll email you a copy of the slides. So we'll follow up with everything that you need. And then let's see here.
Looks like
We've
there's
got
a
it.
question
Thank you for
about
the
links.
links listed above. I'll go to the registration for this session. Okay, thank you so much for letting me know that. I will take a look at those links, Yolanda. I really appreciate that. And then I think you raised your hand. So let me allow you to talk. All right, and you should be able to unmute yourself, Yolanda.
Thank you so much. I just have a question. I was caught up in another meeting, wanted to just ask, in terms of, so when we are a nonprofit and we work with a CPA firm, and what I'm finding is that the CPA firm is most familiar with private corporations, bookkeeping, and I'm wondering, is there a place or resource that I can have, may have access to that has a list of accountants that are specifically for nonprofits who receive federal funding? Does that make sense?
Yes. So for the purposes of this webinar, we're working with the SBDC, and I'm sure that they have their own resource list that they can also provide you in that regard. But another group that to also look into, United Way. I believe they have a branch, and I don't know if it's called the same thing. It's been a while since I've worked with them. It's called the Center for Nonprofit Excellence. And at the Center for Nonprofit Excellence, they have resources, they have courses for nonprofits, because when we talk about a balance sheet, a nonprofit does not have a balance sheet. They don't have owner's equity because they don't have owners. So the terminology is different. It is broken out a little different. There's very specific things. And I can tell you, we have great experts in your industry here locally that are wonderful. I used to work for some of them. So the SBDC has resources. Maybe we can send Yolanda some that list over, Anna, but also the United Way Center for Nonprofit Excellence would be also a great resource for you.
Wonderful. I have used United Way in the past in terms of developing an evaluation. So that will be, I'll check that out. On YouTube, what is the name that you all are under? Is it going to be SBDC New Mexico, or what am I looking for under YouTube? Because the links weren't showing.
You know what, Yolanda, let me try and chat that through again. And then if I need to, I'll contact you directly to make sure that you have all the information that you need as well. I'm not sure why that's happening. My apologies. But
Great.
Yeah, I'll go ahead and pull that up in the meantime.
Just one last question.
We have 10 minutes. Go ahead.
Again. Oh, I just wonder, maybe there are other people who may have questions. When will this be held again, or will it?
I think next week, right, Anna?
Let me check the calendar here. We are going to schedule a couple more, but right now we've got a Tuesday, April 5th at 2:30 webinar scheduled, and then again, April 12th at 2:30. So we will have a couple more of these coming up. Let me chat through the link to our website, and hopefully that'll get you to the right place here.
To be warned, it's the exact same presentation given by me. So if you want a refresher, that's great. But you will be provided, sorry, that's my dog. He's very chatty. This recording along on YouTube and along with the PowerPoint presentation.
Okay, thank you. That's my dog chiming into your dog, so thank you.
And Yolanda, I did just chat through that link for our live webinars. Let me know if you're able to access it. And I will chat through the YouTube as well. And I can reach out to you via email if you'd like me to make sure that you have everything that you need. Or if you want to get in touch with me, if you don't, let me know. It's NMSBDC webinars at sfcc.edu. That will all be emailed to you in a follow-up email as well, just so you know.
That's great. I will look at the email because I just tried, I cut and pasted that again, and it's still going to this this particular webinar that we're in now. Registration.
Okay. Yeah, and I've found that sometimes there's an issue copying and pasting from the chat box, which is what might be happening, is that it's just pulling up your last copy and paste. So that's what might be happening. But yeah, I'll be sure to reach out to you. And thank you so much, Yolanda. I appreciate it. Amanda, I think we have a question in the Q&A. Did you want me to read that to you, or did you want to pull it up?
Yes, if you wouldn't mind, that'd be great.
Okay, yeah. So we've got a question from Kurt. Kurt says, I recently started a residential construction company. Is there any templates that I could use to help compare construction terminology with these bookkeeping terms? Also, does QuickBooks break everything down based off of industry?
QuickBooks really tries to be super intuitive. So it does help. It depends on the type of construction that you're doing, because the construction industry with the projections and the costs associated with each project, and there is industry terms that are accounting terms called like work in progress, and there's other things that affect your taxes, meaning how much of the profit is taxed this year, even though the project isn't fully completed, and how does that shake out as a project kind of goes through. And so if you're a big, construction company working with a state doing $1 million jobs, then that gets a lot more complicated. So I would go through. I don't know if the SBDC has anything specific to the construction industry, but I know there's tons of stuff online. And I would imagine QuickBooks does have, if you tell them you're in the construction industry, that they would give you a chart of accounts that would make sense for a construction industry. Because you're starting out, it may not be as complicated as some of these other things. But to be able to keep track of everything and be able to track by project, that adds kind of a layer of complexity, because not only do you want to know, right, on lumber, how much you spent for the year, because let's just say it's post-COVID and lumber's nuts, right? But how much did you have to charge on that one job? And you bid the job out for something, the costs maybe have gone up since then, and the agreement's the agreement, and you kind of want to see where that shook out. And so, yeah, being able to track that is great. There is contractor associations, just like the restaurant association and stuff like that in town. So you may find a contractor or construction organization or association that might fit your business, so that you can find shared resources. That would be my recommendation. Do we have anything specific to construction that the SBDC can provide?
I was actually just going to copy and paste some information into the chat, and I ran into the same issue as Yolanda. So what I would say at this stage is keep an eye out for the follow-up email that we'll send, and then you can get in touch with me that way, and we can provide more specific information, Kurt, and I can work with you and let you know what we have available to you. But yeah, thank you, Amanda, for that. And Kurt, feel free to raise your hand if there's anything you want to say. I can allow you to talk since we do have some additional time right now, and this is a fairly open forum at this point. So, but aside from that, I'm not seeing any questions.
Well, I can fill up because I kind of skipped over something that y'all might find useful here, which is record keeping and data management. So I found some generalities, right? Some things that could be useful to you when it's say, okay, how long do I have to keep this X, right? And so we just have some general rules of thumb. So for 3 years, you would keep things like general correspondence, like from your tax person and from your customers and that kind of stuff, employment applications. And this may not apply since you're so maybe green in the business, new in the business would be an internal audit. But as you grow, you may have a department that comes in and audits things internally to make sure your controls are correct and that kind of stuff. So 3 years would be correspondence, employment applications, internal audits. 7 years, that's, you hear a lot, right, with tax. Bank statements, canceled checks. If you're not familiar with what a canceled check is, because we don't typically write checks anymore, it would be a physical check that you write to somebody and then they go and cash that check. And then your bank keeps that check. They cancel it once they have fulfilled the payment. And then you can pay money so that your bank can give you those copies of those checks back. So that's what a canceled check is. If you're relying on canceled checks, we should talk because there are better ways to do it, but they still exist and it is applicable. We're still on 7 years. So bank statements, canceled checks, contracts and leases. And I would have a caveat for contracts and leases, keep them for 7 years after they're finished. You may want to keep them longer. I kind of think that that's more of a longer term thing. Expense reports, invoices to customers, invoices from vendors. Personal records, they have an example like a timesheet. If you have employees, you probably want to keep those for a while because things can go bad. We have the paid sick leave now, people can sue you. So having things around is a good idea. Sales records and things that you want to keep forever is actually your tax returns and the documents you needed to put the tax returns together, because I know they say it's the 3 to 7 years and which one is it? But if the IRS ever asks you to go back 10 years, they absolutely can. And if you can't produce it, then you got to rely on what they determine is going to happen to you. So keeping those as a permanent document wouldn't be a bad way to go about it. And with cybersecurity the way it is, I've been told 3 is the magic number. So if you're going to keep something, keep it in 3 places. Keep a physical document. And if you're going to have a digital document somewhere, also keep like an external hard drive or something. So you have it in 3 places. That kind of helps you out. So those are some things that I think might be nice little takeaways from this. And we are down to our last couple minutes. So I will open it back up for questions and hand it back over to Anna.
I think we don't have any questions at this point, but I did want to share that in the chat. We've got a thank you from Della. She says, thank you for sharing your expertise and providing us this training today. Thank you so much, Della. And oh, you put in there, thanks for facilitating, Anna, and for your help with logging in. I appreciate it. Thank you so much. And thank you all for your attendance and participation. Yeah, the New Mexico SBDC is here to help you during any stage of your business. So don't hesitate to reach out to us. Again, we will send that follow-up email with links that you'll be able to copy and paste. So just keep an eye out for that. And then Amanda, if you have any last comments, I will leave it up to you.
No, I think this is great. If you have any final inquiries, you can go to the edmsbdc.org. And my final funny graphic in terms of ending the presentation, because death is not the end. After you die, you get to pay taxes. Like death and taxes. Oh, there is a question.
Oh, okay. Why is that not popping up for me?
I'm not seeing it either.
I'm not seeing it either.
Maybe we can give Joy an opportunity to read that to us, or
yeah,
copy it in the chat maybe.
Joy, I don't know if it's you that had a question, but I've gone ahead and allowed you to talk if you'd like to. So just go ahead and unmute yourself.
Can you hear me?
Yes.
It's the question, it's not my question. It says, I recently started a residential construction company. Is there any templates that I could use to compare construction terminology with those bookkeeping terms? Also, does QuickBooks break everything down based off industry?
Oh, you're so awesome for letting us know that. And I'm sorry if it's still appearing as an open question on your end, but yeah, that was addressed by Amanda earlier. So
sorry.
No, Joy, we really appreciate you bringing that up because, you know, we're here to answer questions and to let everyone know. So thank you so much. And then Amanda, if you wanted to say something, feel free to.
No, no, no. Thank you very much. And if there's any further questions or clarification on how we address that, I'm happy to answer. Just let us know. Otherwise, I think we're at the top of the hour, and I want to thank everybody for spending their time and nerding out with me this afternoon, me and Anna. And if you have any questions, just reach out to us, and we'll be happy to address.
Yes, thank you all so much. And Amanda, as always, great presentation, and we look forward to the upcoming ones. Thank you.